All right, everyone. We've got about 2 minutes until to the actual lecture stream's going to start. What I've done is I have the chat feature, hopefully, where you can see it. If there are any questions that you might have, I'll kind of be checking the chat and also looking at my slides kind of simultaneously. And I put it on hopefully what's a shorter lag. And so the whole goal with the shorter lag is that I can answer your questions more real time. There's sort of an inevitable delay. It's about 10 seconds, I think. And so no matter what, I can't really reduce the lag past that 10-second period. And I'll also try to work on my mic. I know sometimes it gets a little loud, so I'm trying to move it out of the way a little bit. So if there's anything as far as sound or view that doesn't seem to be working, please let me know. But if you wouldn't mind in the chat feature, just real quick, whenever you kind of get on, just let me know. Let me know that you're there. I'm going to kind of put it in the chat right now. Again, we've still got a few more minutes before I get going. Hey, Ryan. So that gives you an idea of the lag. Hey, Arjun. Oh, Marisol. That's a different name there. It is showing your son's name. Darshan, nice to see you. So again, this is giving you a good idea of the lag. Again, I think from what you guys are seeing, it's pretty real time, but for me, it's a bit of a lag. Again, I'm going to give it a minute or two more, and then we'll kind of go from there. I'm trying to see how many. Yeah, so we're up to 15, so people are still kind of popping on right now. Joanna. I think that's Samantha. Carolina. Good morning to you too. At least we have sunshine today. Hey Matt. Accounting is fun. Oh yeah. I love it. Natalia. So as people are still logging on, and before we get to the actual lecture, I did slightly change the way we're going to handle test 5, just so you guys are all aware. The biggest thing is it is going to be open note. And so I wanted to make sure that I could alleviate concerns you might have with, oh, I forgot that detail, or, I know there's a lot of stress when it comes to online testing and online classes. And so I just wanted to kind of maybe create a little space for you by having the next test, and the final exam is also going to be open note as well. Hey, Tammy. And so anyways, we're just going to do that. And then the other thing that I'm doing is there's a practice question where you can practice uploading or using an interface that has a spreadsheet feature within Canvas. And so my goal with the statement of cash flow is that you do a full problem for the test, but you'll be able to use that spreadsheet feature. And so hopefully that spreadsheet feature is much more user-friendly than trying to do that open sort of essay, box kind of response. And so I worked with it a little bit. It seemed to be pretty intuitive, but at the same time, I would highly encourage you to do that practice version a couple times just to get used to it. And I think once you've done that a couple times, you'll start to feel more comfortable using it. It's definitely a lot more flexible way more flexible than that open text box, and so formatting and things like that are going to be much less of a concern. But with that said, I think I'm ready to jump into Chapter 22. If you guys have any questions about Test 5 before I do that, let me just give it a few seconds here and see if anybody has any questions about that. Again, I'm kind of looking over at the chat feature and kind of going back and forth a little bit. Let me just make sure. Okay, so let's get moving here. So Chapter 22, we're going to be going through, I hope, 3 different practice problems this morning. And so they'll give you a taste. Natalia, good question. So given that it's open note, is it going to be much harder? And the answer is no. And so what I've done is I've essentially taken the test that I had before and just amended it to the online format. It didn't make the questions harder or anything like that. And so, but I think just the environment is more difficult, so it might feel a little harder, but it's essentially the same test I've always given. How many multiple choice questions? I'm trying to think of the actual number. There are 0 multiple choice from Chapter 23. So everything from the statement of cash flows is just a statement of cash flows problem. So it's 50 points, statement of cash flows, that's it. And what you're going to do with that is you're going to have a full statement of cash flows using the indirect method, and then you have to just reproduce the operating section using the direct method. And so that's going to be plenty. So that's all 50 points from the from Chapter 22. I'm trying to think how many points. I mean, there's definitely more multiple choice from that chapter, and a few true false and things like that, a few computation, but that's it. So it's more of a mixture for Chapter 22 for sure, but for Chapter 23, no multiple choice whatsoever on Test 5. Let me just give it another second here, and then we'll make sure there's no other questions. Okay, I think we're good. All right, so Chapter 22, practice problems. Let's see here, make sure I'm on the right thing here. All right, so this is just like the ones we had, but again, I'm going to be walking you through the solutions. So 49er Company signs a 10-year lease on January 1st, 2019. The lease calls for annual payments of $5,000 on December 31st each year. The discount rate is 6%. There's no residual value. There's an operating. They treat it as an operating lease, but the auditor re-examines the contract and discovers that it should have been treated as a finance lease. And so for this one, we're going to ignore any tax effects. But of course, this is actually probably one of the harder problems of the 5. I think we had 5 or 6 practice problems. This is definitely one of the harder ones, and so we're going to kind of walk it through slowly, and hopefully we get you through it and you can understand. Again, anywhere along the way, I'm going to try to move slowly in between slides. I know I talk fast, but hopefully that gives you time to ask questions if you have any. All right, so the nice thing is, because we discovered the error early, there's really only need to correct 1 year. And so a lot of times with these problems, don't do more work than what you have to. And so in this particular problem, we only have to correct 1 year. Because we are doing a lease, we do need to understand the time value of money calculations in order to make our correction. So we have to understand what the entries were, and we have to compare that to what they should have been, and then kind of reconcile any differences there might be. And so that's the challenge with any of these problems, is trying to figure out, okay, what accounting actually occurred, and then compare that to the accounting that should have taken place, and between the two, then you can get to the journal entry or any corrections or restatements that you need to make. All right, so starting with the time value of money. So we're talking about the lease, the present value of a lease, and we need to do that calculation. So it is a 10-year lease. It's an annual lease, and so the discount rate of 6% is the discount rate. Each payment is $5,000. There is no guaranteed residual value or anything like that, so the FV is 0. So our framework for the present value of the lease is actually pretty simple. And for Chapter 22, if I have anything, all of it's going to be simple as far as the underlying accounting. That the difficulty is the correction. And so when we do that, we get a present value of the lease of $36,800. And so with the $36,800, then we have to kind of imagine the journal entries and kind of think about what maybe they should have been if they had done it correctly. Okay, so we're going to use the time value of money to amortize the lease liability, but we also have to use that information to understand what we had recorded for the right-of-use asset under the operating lease. Because if you remember, the amortization of a right-of-use asset is tied to that lease expense schedule, which kind of goes back into the amortization of the lease liability. Again, just as a reminder, we only need 1 year to correct our error, so we don't have to have a 10-year amortization table. We can have a shorter amortization table and still get all the corrections that we need. Alright, so looking at the amortization table, we signed the lease on January 1st, 2019, and each payment happens on December 31st. We only need 1 year, and so we're good. We're good by just looking at 1 year in the amortization table. We start with a carrying value of $36,800. And then we fill in the line. Of course, the payment is the contractual obligation to pay. The interest, again, we're being careful about not saying interest expense, because in the context of an operating lease, we're using the interest to get the amortization, but we really don't have any interest expense. So I'm just being careful with the way that I'm using the amortization table here. But there is interest, and that interest is 6% times the previous carrying value, which is the $2,208. The amortization, of course, is the difference, and then the carrying value is $34,000. So I have a couple questions here. Can you upload these slides after the session ends? Yes, absolutely. I'll do that as soon as the session ends. And should it say lease expense instead of payment? No, this is the amortization of the liability, and so this is absolutely about the payment on the lease. Now, it just does so happen that the lease expense schedule looks exactly like this. And so anytime there's an end of year payment, the lease expense schedule and the amortization of the lease liability are going to look the same, assuming that it's an even payment and all that kind of stuff. And so in this case, really the two look the same, but I'm specifically having in mind here the amortization of the lease liability. That's really what I was after with this particular table. Okay, so let's talk about the accounting for the right-of-use asset. And so as we had reported, again, we would have reported using the lease expense schedule. That's what we would have been doing with the right-of-use asset under an operating lease. And so the amortization in 2019 would be taken from the table, and that amortization would have been $2,792. And so that's the reduction to the right-of-use asset that we would have recorded. So the balance in the right-of-use asset would have been the initial balance of $36,800, because that was the present value of the lease, and we would have subtracted the amortization from 2019 for an ending balance of $34,008. So that would have been the ending balance for the right-of-use asset under an operating lease arrangement. But now we got to think about the restated approach, and so we should have been using this as a finance lease. And so under a finance lease, we use straight line amortization for the right-of-use asset rather than using a lease expense schedule. And so in this case, the 2019 amortization would have been 1/10 of the initial carrying value of the right-of-use asset. And so the carrying value was $36,800. We divide that over 10 years, which means the annual amortization would be $3,680. So notice that the amortization under the operating lease arrangement is different than the amortization under the finance lease arrangement. And so the balance would be $36,800 minus that year's amortization for an ending balance of $33,120. So notice that the balance in the right-of-use asset is different under the two lease arrangements, and that's important that we see a difference in the balance. If there's a difference in the balance of the account, that means we need to correct the balance. And so in this case, that correction would be a reduction to the account balance of $888. And so again, we're reducing the right-of-use asset by $888. That's the way that we would correct this error. And so let's ask ourselves, and we're going to do one of those count to three kind of situations. And so when you're asking yourself this entry amount to reduce the right-of-use asset, is that going to be a debit or a credit? On the count of three, 1, 2, 3. And that would be a decrease to the right-of-use asset, so that would be an $888 credit. Again, for these 1, 2, 3, good job, Zuli. She got the credit. If you're confident, I think it helps to kind of put it in there and put it in the chat feature and see if you got it right. Of course, it's not required, but at least say it out loud or something like that to yourself so you know whether you got it right or not. I will say as much as you can, use the chat feature to ask questions, provide feedback. If it makes sense, say, oh, okay, I got that. That makes sense now. And the only reason why is because usually when I do these lectures, I have a face to look at, right? And I can see, oh, they're getting it. And so if you could give me a little nonverbal feedback through the chat feature, that would be helpful. But hopefully that makes sense. Okay. So now let's talk about the lease liability. So again, as reported under an operating lease, you would use effective interest amortization. And so under the restated approach with the finance lease, you also use effective interest amortization. So the nice thing for the lease liability is under both approaches, the amortization of the lease liability is exactly the same. And so there's no entry that's required for the lease liability. So we don't have to worry about any adjustments to the lease liability. We only have to worry about the asset. So, all right, Samantha, I'm glad it makes sense. Again, as much as you guys can, provide feedback if you can. Again, ask questions anytime, and I'll do my best to answer them. All right, so next step then is to think about any expenses. Now this is probably where this gets a lot more complicated. And so we're going to kind of walk through the two types of leases and what would have happened. And so as reported, there would have been a lease expense. Remember, under an operating lease, the only thing you record as an expense is the lease expense, and that's even over the life of the lease. And so there would have been a $5,000 lease expense in 2019. With the restated amount, which would be the finance lease, now you have two different expenses. You have the interest expense and you have amortization expense. And so when you talk about the interest expense, you'd have to go to the amortization table, and the interest column is where we get the $2,208. And so we would have recorded interest expense of $2,208 in 2019 under a finance lease. We also would have had amortization expense related to the right-of-use asset, and we already had calculated that, and that expense would be $3,680. And so we'd have total expenses under the finance lease of $5,888. Notice that the total expense of $5,888 is different than what was reported under the operating lease, where the lease expense was only $5,000. Now, the thing we have to remember here, though, is that the lease expense account had been closed, so there's no account balance in the lease expense account. At the same time, if we had correctly reported our interest expense and amortization expense, both of those accounts would have also been closed, and so there's no existing balance in any of these temporary accounts that needs to be corrected. However, when we talk about the entry, there is a permanent account that's going to need to be adjusted. And of course, you see hopefully the hint in the slide up there that these things all close to retained earnings. And so the retained earnings account is where we need to focus our attention. And so the change in total expenses would be an increase of $888. All right. So Zuli asks a question, how would it be different if the payments weren't on 12/31 for an interest expense? Would we need an adjustment? So let's say that we discover this error July 15th or something like that. And if it were like a semi-annual, or let's say payments had happened on June 30th, then we would have a temporary account. the interest expense would have needed to be recorded, and we likely would have recorded lease expense. And so in that case, because we haven't closed those accounts, we would need to correct those temporary accounts. But in this case, there hasn't been any new temporary account balances to deal with. So this one's much easier, and on the test, it's going to be like that. I'm not going to have temporary and permanent accounts. We're only going to be dealing with permanent accounts. That's a good question. So now we have this entry amount, this change in total expense, an increase of $888. And so when we talk to or kind of think about this journal entry, again, kind of on the count of three, be thinking about the account and whether the entry to that account is going to be a debit or a credit. And so on the count of three, like I would say, debit whatever account or credit whatever account. So we had a change in total expense. And so on the count of three, try to verbalize or type in the entry 1, 2, 3. And hopefully you got that this would be an $888 debit to retained earnings. Good job, Ryan. So, Marisol, so I think you got credit. Remember, this is an increase to an expense. So with the expenses, those are going to be debits to retained earnings, not credits to retained earnings. Oh, she caught herself. Good job. All right, so $888 debit to retained earnings, and of course, now we have to put all of those accounts or both of those entries. Good job, Samantha. So now we have to put those entries together. So then our journal entry, of course, is the debit to retained earnings and the credit to the right-of-use asset, each in the amount of $888. Hopefully by the time you get to the journal entry for this problem, you're like, okay, got it. Okay, so now let's talk about financial statements. And so in your take-home problem, I didn't actually provide revenues and expenses or anything like that. Rather, I just kind of said, hey, here's the change to this account. On the test, it's going to look something like this. And so I wanted to give you a format that's going to allow you to practice a little bit for the test. And so rather than having specific accounts for this type of problem, you're going to have this, debit or credit. Now you got to figure out, okay, is there an impact on revenues? Is there an impact on expenses, assets, liabilities, equity? Which general balances are going to be affected by this correction? And so, again, just as a matter of practice, of course, they're not, in the real world, you'd have to know exactly what account and exactly where that would show up, and think about the financial statements and what did I report and what do I need to fix, and I'm just simplifying it for this class, and it's going to be that way on the test as well. And so we're talking about revenues, expenses, assets, liabilities, and equity. And so in your own mind, we're going to start with revenues. Given this situation, are revenues going to change or are they not going to change? And so so in other words, is the restated amount going to change? And so on the count of three, just think about yes or no to that question. Is the restated amount different than the as reported amount? Again, 1, 2, 3. And the answer is no. The restated amount and the as reported amounts are exactly the same. Good job, Ryan. Good job, Joanna. Good job, Zuli. Again, all of these are... there's no change. So this is only dealing with expenses and the balances to different accounts. And so, not that I just gave it away, but I want you to try to think about the number. So we know that total expenses are going to change. And I just want you in your own mind to give me the new number. And so, again, on the count of three, think about what the restated amount is going to be. 1, 2, 3. So again, the expenses increase. Good job, Brian. They increase $888, and so the new total expense is $95,888. Zuli, Natalia, good job. You guys both got it as well. So total expenses, $95,888. So now total assets. Again, kind of in the chat or in your own mind, get a number in mind that would be reported as the restated amount. Again, I'm going to give you a second to think about that. And the new amount would be, just count it, 1, 2, 3. Again, the right-of-use asset has a reduced balance, by $888. Good job, Zuli. Samantha, I see you got the previous one for total expenses. Good job. This one's definitely a little harder as far as the total assets. So the balance in the right of use asset is reduced by $888, and so the new balance is $544,112. And then total liabilities, hopefully this one's a little easier. There's no change to that account balance. Good job, Samantha. And then total equity. So we'll just kind of complete the picture here. Total equity, the new account balance and total equity on the count of 3. 1, 2, 3. Give you a second if you're using a calculator. And the new account balance is $219,112. It's not the same for total equity because remember we reduced our retained earnings by $888. Good job, Joanna. So the reduction by $888 gives us a new balance, a restated account balance for total equity, $219,112. So I'm going to stop or pause here for a second and see if there are any other questions before we move on to the next problem. So some of you are having longer lags. Hopefully it's not several minutes. It sounds like for Samantha it's several minutes. I know when I had done it, it looked like it was about 10 seconds. I'm hoping that it's more like 10 seconds. If you wouldn't mind just very quickly, again, it might be hard for you all to tell how long the lag is. Okay, so second practice problem. Ford Air Company issues a $100,000 9-month note. Natalia suggested, Samantha, that you maybe refresh the page, and that'll reduce the lag. So I'm guessing that's not everybody, which is good. Okay, good job, Lily. Yeah, just understand, again, just so you're aware, I'm going to have very basic problems for Chapter 22, so there's not going to be a very intense one. However, in preparing for the final, understanding how to do operating and finance leases is going to be helpful. All right, so this 9-month note, they issued it on October 1st, 2019. The interest rate is 8%. And the note pays interest at maturity. And so on February 15th, they discover that they had not accrued interest at its fiscal year end on December 31st. Under the Internal Revenue Code, there's no need to do so. And so in this one, hopefully you can see right away, we are not ignoring tax effects. And since we're not ignoring tax effects, we've got a little more to deal with on this particular problem. All right, so again, we only need to correct 2019. That does make this a little bit easier. We have to understand the tax effects of the accrued interest. So remember, if we had correctly accrued interest, there would be interest payable. And so we have to think about, in terms of an interest payable, what that would do. So that payable is going to have, that payable exists under U.S. GAAP, and it does not exist under the Internal Revenue Code because the Internal Revenue Code doesn't accrue interest payable as a deduction to our taxable income. And so for this problem, there's either going to be a deferred tax asset or a deferred tax liability. Again, in the chat feature on the count of 3, you're going to see DTA or DTL. 1, 2, 3. And the answer is a deferred tax asset. Again, because there's a payable in the framework of the balance sheet, A minus L, that minus L means that net assets for this particular item is less under U.S. GAAP. So that less than situation means we have a deferred tax asset. So Dylan said DTL. Hopefully you see now why it's a DTA, again, because we're dealing with a liability and we're dealing with expenses rather than dealing with assets and dealing with revenue. So it will result in a deferred tax asset. Oops. Well, there's a problem. All right, so let's talk about the interest payable. So somehow in my running it through, good job, Dylan. Let me just kind of get to where we were at there. All right, so for interest payable, again, I think I had mentioned in the previous lecture that there's this idea of the full effect versus the tax effect versus the after-tax effect. And so when we talk about accruing interest, that payable is going to reflect the full effect of the accounting. And so previously when they had reported, they didn't report any payable whatsoever. So there was nothing. They hadn't reported anything. But under the restated approach, in other words, once they understand, oops, we should have accrued some interest, you have to understand, well, how much interest should they have accrued? And so the $100,000 note has an 8% interest rate on it, and they would have accrued 3 months. And so they should have accrued $2,000 in that interest payable. And so the entry amount is a $2,000 increase to the interest payable, $2,000 increase to the interest payable, which would be a $2,000 credit to that account. So the entry amount is a $2,000 credit entry to the interest payable to correct the error. I probably made the same mistake, yes, of course, so we can't have the fun 1, 2, 3 stuff, but that's okay. So for the deferred tax asset, again, the DTA reflects the tax effect from the difference in US GAAP versus the Internal Revenue Code. So again, there would have been nothing reported previously because they didn't accrue any interest. But under the restated approach, in other words, once they actually correctly accrue the interest, we have to think about the tax effect. So Samantha asked, did we skip practice problem 2? Yes. We skipped it. So I went to 3 because I wanted to do a DTA, DTL, and we're going to go back to number 2 here in a minute. The tax effect from the interest payable, the 40% for future questions. So for the practice problems, yes, assume a 40%. For the test, I will give you a tax rate though. So you're not going to have to guess or infer a tax rate on the test. I'll give it to you. So the deferred tax asset then has a tax effect from the interest payable. So you take the increase to the interest payable, that $2,000, and you apply the tax rate, the 40% tax rate, which means there should be an $800 balance in the deferred tax asset related to this interest payable. And so the entry amount, there's a incorrect statement there. It should be an $800 increase to a deferred tax asset, which would be an $800 debit to that account. So again, sorry about this particular slide. It wasn't pretty. The animation didn't go in the direction I wanted, but at the end of the day, there is an $800 debit to the deferred tax asset. And again, the animation didn't really do what I wanted it to do. That's okay. So we got a lot going on this page. So I'm going to kind of walk you through. Try not to read too far ahead. Unless you've got it, then don't worry about it. But let me kind of talk about this. And so the second piece of this, and this does get a bit complicated, is there's an interest expense that we should have recorded. But with that, there would be a change to our income tax expense because now there's a reduction to our pre-tax financial income. Both of them together have an impact on retained earnings. So the change in the interest expense and the change in the income tax expense together have an impact on retained earnings. That total effect is the after-tax effect. So we have the full effect in the interest payable, the tax effect for the DTA, and the after-tax effect for retained earnings. And so now we have to walk ourselves through what's the after-tax net effect from these two items, the interest expense and the income tax expense. So again, there was nothing reported, so that's the easy part of this. With the restatement, of course, there would be interest expense. The amount of interest expense would be a $2,000 increase to the interest expense. The increase in interest expense is a decrease to retained earnings. And so related to that interest expense, there'd be a $2,000 debit to retained earnings when that account gets closed at the end of the year. So there should have been a $2,000 debit to the retained earnings account related to the interest expense that was eventually closed. At the same time, the income tax expense would be different. So there'd be a decrease to our income tax expense, an $800 decrease to our income tax expense. The decrease to the income tax expense is an increase to retained earnings, and so when it got closed, there'd be an additional $800 credit to retained earnings. And so together you can see that the one results in a $2,000 debit to retained earnings and the other results in an $800 credit to retained earnings. So in total, the net journal entry to retained earnings is a $1,200 debit entry. That's the after-tax effect from the accrued interest. I'll give it a minute here because that's probably the busiest slide that we have as far as how to work out these problems. I'm not seeing any questions yet. I'm going to give it a few more seconds. Okay. So our journal entry, a debit to retained earnings for the after-tax effects of $1,200. The DTA related to the interest is the tax effect of $800, and of course the interest payable credit is the full effect of $2,000. All right, so now we're talking about our financial statements. Hold on one second. So I'm going a little more quickly through this one, just because, just in the interest of time, because I'm already at 35 minutes, and I kind of anticipated I would be running a little short on time, and so I kind of pre-filled this one out. But I do want to walk you through each piece of this slide. Hopefully you see that total revenues are not going to be affected. I broke up, and I'll do this on the test as well. So when we're talking about income taxes, I'm going to have income tax expense separated from other expenses, and I'll also call out the deferred tax asset or deferred tax liability separate from other assets or other liabilities depending on which one we have. And so this is kind of the framework that you'll see on the test. So still broad, but just a little more nuanced because we do have to worry about taxes. And so again, the total revenues are not changed. Other expenses outside of the income tax expense do change by $2,000 because we would have that $2,000 increase to our interest expense. And so rather than $188,780 in other expenses, we'd have $190,780 in other expenses. At the same time, we know that our income tax expense is reduced by $800. And so our new restated income tax expense would be $17,928. At the same time, we know that there is this increase to our deferred tax assets of $800, and so our new DTA balance would be $6,550. There are no other assets that are affected by this correction, and so our other asset account balance does not change. And then our total liabilities do change because we have the $2,000 interest payable. And our total equity changes because we have the net effect on retained earnings, which was a decrease of $1,200. And so all the information kind of flows together, and hopefully you kind of see that. So we have the income related items, which are the first three, and then we have the balance sheet related items, which are the last four. But again, it's the $2,000 difference in the interest payable, and also, of course, the interest expense. But then you have the DTA, the income tax expense, lots of things going on with this particular problem. But hopefully, by kind of seeing it, sort of one by one, you're able to get there. But again, I'm going to leave a few seconds here for you to ask a question before we go to our final problem. Okay. Final problem. So this is problem number 2 on your sheet, but it's just going to be the third one that we do here. It's going to be the last one that we do, just in the interest of time, because this is going to probably put us right at 45 minutes, and I'm trying to keep these to around 45 minutes as best I can. So 49er Company issues a 10-year annual bond on January 1st, 2018, and each bond, or the bond, has a $1,000 par value. The bond is issued at 93 and has a 4% contract rate. On March 1st, 2020, 49er discovers that it had mistakenly applied straight-line amortization to the bond discount over a 5-year period instead of the 10-year period. And we're going to ignore any tax effects from this one too. But again, the deal here is that they have this issue of having amortized the bond over 5 years instead of 10 years. And so we've got to figure out how to handle that. All right, so there are 2 years in this case that we need to correct, 2018 and 2019. And so the bond is issued at 93, which means there's a 7% discount at the initial issuance. And so if the bond payable account balance is $1,000, 7% of that bond payable would be 70. And so the initial balance in the discount account would be $70. So let's talk about how we correct the discount on bonds payable account. So as reported, they would have done straight line amortization over a 5-year period. And so $70 divided by 5 means they would have been amortizing $14 per year. The total amortization would be 2 years, so the total amortization would be $28, which means the discount balance would be the initial balance of $70 minus the $28 of total amortization, which would give us a new discount balance of $42 at the end of 2019 prior to them discovering this error. The restated amount would be straight line amortization over 10 years, and so the annual amortization would have been $7. So the correct amount is $7 per year instead of $14 per year. And so the total amortization over the 2 years should have been 14 rather than 28, which means the discount balance should be 56 rather than 42. And so the amount or the change to the discount on bonds payable is a $14 increase. Now, we need to ask ourselves, to increase a discount on bonds payable account balance, is that a debit or is that a credit? So on the count of 3, you're going to say debit or credit. 1, 2, 3. And hopefully you see it is a debit. Good job, Lily. So an increase to a discount on bonds payable. Zuli said credit. Remember, the discount is a contra liability. So it's a contra liability account. And so the normal balance for a contra liability is a debit, and an increase to a contra liability is also a debit. So while Lily was unsure, she did get it. Good job. Zuli, hopefully you see the mistake that you made. Again, it's a contra liability, so it's hard to think about sometimes, and that generally is the challenge for some of these problems, is kind of getting in your head, okay, what should this look like? So knowing the amount and knowing that it's a debit versus a credit, there's sort of a twofold challenge there. Again, for whatever reason, my animation did not do what I wanted it to do. Oh well, we'll just kind of live with it. So at the interest expense, again, we have to think about what happened to the interest expense account. It got closed to retained earnings. So the interest expense account gets closed to retained earnings. So what was reported as interest expense would have been the interest of payment plus the discount amortization. That's what would have been reported. So the annual interest payment, the contract rate on the bond was 4%. So the annual interest payment is $40. What they had reported was an additional or amortization of 14, and so the annual interest expense that they would have reported would have been $54, and that would, of course, would have been a debit to the interest expense account. Under the restated approach, or the correct approach, the only thing really that changes there is the amount of the discount amortization. So the interest payment is still $40. The amortization should have only been $7. So the annual interest expense should have been $47 instead of $54. So let's talk about the interest or the entry amount. So the change in the interest expense is a decrease of $7 per year. So in other words, we had overstated our interest expense by $7 per year. And so, again, we have to ask ourselves, what account needs to be corrected and what amount? Right? So it's going to be so many dollars debit or so many dollars credit. So I'm going to give you a little more time on this one. So you're going to give me the account name and the amount of the entry to that account. So again, account name, the amount, and whether the amount should be a debit or credit. Go ahead and put it in the chat if you want, or in your own mind, do some calculations or whatever. I'm going to give you a few seconds just to kind of walk yourself through that and understand the entry amount that should be part of this part of the correction. So So our credit to retained earnings of 14. Natalia agrees. Retained earnings, $14 credit. Another. So now we have $7 credit. Samantha, 14 credit. Natalia got it. Yep, 2 years. So Joanna, hopefully you saw that. It's 2 years, not 1 year. So now we have debit retained earnings for 7 from Zuli. See if that's it. Not 14. There, she caught it. So it sounds like we're settling on 14, and now we're trying to figure out, is it a credit to the retained earnings account or is it a debit? All right, I'll give you the answer. So we did the 14 amount, good, so 2 years. And then finally, it is a credit to retained earnings, a credit. So remember, a decrease to the interest expense means there's an increase to income, right? So there's sort of this decrease to interest expense is an increase to retained earnings. And so it is a $14 credit to retained earnings because the decrease in interest expense implies there's an increase to retained earnings, and so we need to adjust that account balance with a $14 credit. So almost everybody got it. I thought that was pretty good. So well done. All right, let's talk about the journal entry. Again, we have the discount on bonds payable with a debit of 14 and retained earnings with a credit of 14. All right, so now the financial statement accounts. And so again, this general framework of revenues, expenses, assets, and liabilities. The challenge with this problem is there are 2 years, 2018 and 2019. And I will say, whenever we jump to 2 years, this is where students do struggle a bit more. So we're going to go slowly through this, but I wanted you to just be aware that if you don't get some of these numbers, you're not alone. And so let's first of all talk about total revenues. Are there any changes to total revenues if we needed to adjust or correct the way that we had amortized a discount on bond payable? And you can, in the chat feature, you can say yes or no, as soon as you're able. So should there be a change to our total revenues in either year? So we have a no from Lily. It's correct. Ryan says no. Also correct. Joanna, no. Good job. Okay. So restated amounts, typo on my part. So 2019 restated amount should be 1,467. I was probably copying and pasting and not paying attention too well, so I apologize for that. But the restated amount for 2019 should be 1,467. So now let's talk about total expenses. So will there be a different amount reported as far as our total expenses? Just so give me a yes or no. But if your answer is yes, give me the amount that should be reported in 2018 and the amount that should be reported in 2019. So total expenses, the restated amount for 2018 and the restated amount for 2019. Again, go ahead and try to type it into the chat feature if you're able. Lily says a $7 decrease each year with the question mark, meaning that she thinks she knows, but she's not sure. Let's see if anybody else chimes in. Anybody agree with Lily? So for 2018, Marcel says 1,136. So that would be the $7 decrease. So she agrees with Lily for 2018. And also agrees with Lily for 2019. So they're on the same page. Let's see if anybody else wants to chime in. All right, let's see. All right, so Lily and Marisol were both right. So good job. $7 decrease each year. Remember, the cumulative effect is $14, but within each year, the effect is only $7. And so remember, the income statement is year within year. And so in 2018 and 2019, it's $7 decrease to the expenses each year. All right, so is there a change to our total assets? Hopefully you see there is no change to our total assets. Total liabilities. Now there is a change to our total liabilities, so I'm going to again give you some time here to give me a new amount, a restated amount for each year. So the restated amount in 2018 and the restated amount for 2019. Let's see if anybody gets a new number here. So no one's answered so far. There we go. So let's see. So we have for 2018, 2002. So an increase of 14. Okay. Zuli asks, why wouldn't we restate the account cash? So the change in the way that we amortize the discount does not change the amount of cash that we paid. So the cash account balance is not going to change regardless of the way we amortize. So again, hopefully that makes sense, that the cash account is not going to change. So Arjun, he has looks like a $7 increase to the total liabilities in 2018, and then looks like a $7 increase to liabilities in 2019. So he's basically saying increase each $7 each year. Lily's struggling with okay, what's this going to do to the liability? So we have an increase to a contra liability. What's that going to do to total liabilities? All right, let's start with 2018 and 19. So Arjun had the let's see, he had the amount right in 2018, but he had the direction wrong. So again, when you think about an increase to a contra liability is going to create a decrease to total liabilities. And so that contra liability account balance needed to increase by $7 in 2018. And so the new restated account balance is going to be $1,981. Now, 2019 is a little more difficult because this is the balance sheet. And the balance sheet accumulates effects. So not only do you have the $7 change in 2018, but now you have the $7 additional change in 2019. So now the total change is $14 in 2019. So I think Arjun got it, which is good. But again, it's a decrease. So $7 in 2018, and then 2019 you have 7 plus 7. So now it's $14 in 2019. So in total it's 14, and again, this is the part where students typically get it wrong. I'm just going to be honest. It's that second year versus first year. That's usually where students struggle, is thinking about the balance sheet, that it accumulates. It has to accumulate year over year. So now the total equity, the total liability should give you a little bit of a hint on what needs to happen with total equity. So I'm going to give it a few minutes here again, and again you're going to give me the restated account balances for 2018 and 2019 for our total equity account. Again, I do believe that you have a good chance of getting this right if you think about what happened with our total liabilities. I'm going to give it a few minutes though to see if anybody wants to chime in with what they think might be the answer. So Lily says 1475 and 1753, which would be a $7 increase in 2018 and a $14 increase in 2019. Looks like Samantha agrees with 2018. Ryan agrees with Lily. Ha! Nice. She types faster, Ryan. She types faster. And then Samantha says 1755. Joanna agrees as well. So Samantha's $2. She says 1455. Where'd we get that number? I'm guessing that might be a typo, Samantha. All right. Let's see what we got. So 1475 and 1753, Lily was correct. Good job, Lily. Again, a $7 increase in 2018, and then it accumulates to a $14 increase by 2019. And the nice thing is that assets still need to equal liabilities plus equity. And so if there was a $7 decrease to liabilities, there must have been an offsetting $7 increase to equity, assuming assets stayed the same, which they did in this case. And so hopefully that also gave you a little bit of a hint. All right, that is the end of the 3 problems that I wanted to go through. I went over a little time. I try to keep these to 45 minutes as best I can. With the statement of cash flows, we're going to start on the statement of cash flows on Thursday. That is well beyond 45 minutes of work. So we'll just kind of have to decide. I'll probably try to go a little bit longer and get through the problem. That way you have a full week before the test to keep reviewing that. And so Thursday's live stream probably is going to be more than 45 minutes. I apologize for that. I know it's kind of tough to hang in there for that long. But to get all the way through a statement of cash flows problem, that's going to be probably what we're going to have to do. And thank you, Natalia, for supporting that. I'd prefer to do that rather than do 45 minutes and stop, and then pick it up next Tuesday or something like that. And thanks, Zelia, appreciate it. Any last questions before we close this thing out? So practice number 5. So Natalia has a question about practice problem number 5. Encourage the more than 45 minutes. Thank you. So Natalia, rather than ask the question here, we can do a WebEx meeting tomorrow, and you can ask that specifically, or you can email me the question. It's a little, with the stream, it's a little bit tough to kind of format it in a way that's going to be visible. I'm not sure that I'll be able to pull that off. But let's do that via WebEx. So there's still slots available tomorrow. If they get full, then I'll open more up. Zuli has the same thing. What I could do for going through practice problem, group WebEx. That's exactly where I was going to go. And so Natalia suggests a group WebEx to work through some more things tomorrow rather than doing a live stream. And so what I'm going to do is I'm going to create a WebEx event. The WebEx event tomorrow will be more of a interactive kind of where I can share my screen and more of a chat kind of back and forth, but it's not going to be recorded or anything like that. So that's just more of a what I would call a more like office hours, open office hours rather than individual appointments. And so yes, you will be able to join, and there will be something there. All right, everybody. I think that covers it. Thank you for hanging in there, and I hope you all have a wonderful sunny day. So Arjun, sorry. Will group WebEx cancel out? No, it will not. I'm going to do it additional time. right, take care, everybody.